Hey everybody, Preston Bryn here with our weekly roundup brought to you by our trader user group. This is for the trading week ending May 17th, 2019. Well, is the cup half full or is it half empty? Depending on who you listen to, I've heard everything from another 10 to 15% to the downside, or I've heard 5% to 7% to the upside. I think there's a lot of turmoil in the market right now, but first, just a quick recap. Both the Dow, S&P, NASDAQ, and Russell, all of the indexes, the U.S. indexes, are down this week. The Dow down the least, about 69 basis points. And the Russell, which we'll take a look at the charts here shortly, was down the most at about 2.28%. VIX was higher. Coming in for the week, it closed at 1596. And roughly about where it was last week, but we've had a little bit of bouts during the week, especially on Monday of this past week. And the world markets, well, Europe didn't. They did okay. They held in pretty good. The FTSE, the London market, was up a little over 2%. The Paris, France, French market, the CAC 40 was up a little over 2%. The DAX was up almost 1.5%. And then over in China, they suffered a little bit more. The Nikkei was down about 44 basis points for the week, and China was down almost 2% for the week. And then looking at the sector performance for this week, the best performing sector was utilities, and the worst performer was the industrials. Utilities up over 1%. But what we saw this week, some of the risk-off sectors like utilities, real estate sector, consumer staples were leading the three sectors to the upside, and then technology and industrials leading to the downside. And then just looking at PE ratios and multiples, the prior 12-month PE ratio is 22.07. But as you guys know, I like to look at the forward PE because that's what the markets are really trading as forward earnings estimates. And right now, it's still just, I think, a little bit slightly rich at 17.15. But given the very low interest rates, it's probably considered okay. Remember, the lower the interest rates go, then the higher a PE multiple tends to run. So that's a little bit about just an overall where the indexes are sitting up right now. But what we're seeing as we're heading into the summer months, we're seeing trade negotiations with China really dominating the markets. And we're also seeing companies that have less exposure to China are doing slightly better than those that do. So for example, a lot of the semiconductor stocks are just getting taken to the woodshed right now, especially those supplying chips to Huawei Technologies. As a reminder, this past week, the U.S. imposed curbs and sales for U.S. companies dealing with Huawei. So that really dramatically expands our trade negotiation from just tariffs towards longer term issues around security and spying and things like that. So that's really dramatically expanded where the U.S. is taking this thing. So as the trade war kind of moves forward, we're seeing the U.S. and the White House administration place more focus on China. And one of the reasons why they're doing that is they only want to have to juggle one thing at a time, primarily China. It's a really big, important thing to the Trump administration. So that's why this past week they also lifted steel tariffs to Canada and Mexico because they want to speed up the USMCA trade agreement. That would be the U.S., Mexico, and Canada trade deal. They want to speed that up. And there was rumblings in the Democratic Congress and some in some Republicans, but mostly Democrats, that they wanted to get those trade steel tariffs lifted. So we did. The administration did. And the other thing that they did this past week was extend or delay the possible auto tariffs on Europe by another 6 months. So that means right now the only focus is China and only China. Okay. So we've got that over in the Asian Pacific area affecting global markets everywhere. And then over in the Middle East, we're starting to see sabers rattle in the Persian Gulf with the U.S. and Iran as U.S. applies more pressure to halt as best possible all the oil exports out of Iran. And that's creating a lot of tensions, escalating further with Iran coming back and declaring the U.S. The enemy of everybody. And so they're putting They've threatened U.S. forces there, so Trump's responded by putting a battle group or a carrier group over there in the Persian Gulf. We had a couple of tankers, holes were blown holes in Saudi tankers, and the Iranians are saying they didn't do it. In fact, they blame the U.S. saying the U.S. is trying to start a war. So there's just a lot of mess over there, right? I mean, who knows what's going on, but just a lot of mess. Right now, the saber rattling over in the Persian Gulf between the U.S. and Iran is really only affecting oil markets right now. It hadn't really escalated to other markets, mostly just oil at this time. We're also got the issues, of course, with Libya and Venezuela and OPEC as far as the oil exports and the amount of oil produced and demanded each day by the global market. So oil, it came down just a small amount on Friday, but it's still in the low 60s, kind of in an area where I don't see how it can sustain itself at that level. I believe, and I've said over and over again, that I think in the mid to high 50s is where oil should be. But when you throw all these global tensions out there, then oil can run all the way up to $70 a barrel, especially if fisticuffs start coming to be over in the Persian Gulf. I mean, we'll see oil move up $10 a barrel very quickly, and that's also going to drive the global markets down too. So there has it's been kind of on the back burner, but it has a way of just jumping right back and imposing and exerting downward pressure on the global equities if that stuff does come to pass, right? Now, the markets, I want to point out that given all of these geopolitical risks that I've talked about, primarily with China, which seems to be the markets seem to be reacting on a headline by headline or tweet by tweet basis. It's kind of settled down a little bit. But the markets are placing big bets that this trade tiff with China is going to be resolved, not necessarily in the next 60 days, but clearly tensions are going to be reduced. They're making that bet because Trump's planning on meeting Xi in Osaka, Japan. I think the G20 meeting kicks off around third week in June, June 21st, somewhere around there. And then the markets are planning that Trump doesn't want a full-blown trade war and all the things that come with it. Neither does Xi, because heading into 2020, we got the election season here, and I think Trump wants to talk up a strong economy and the bullish stock market. And meanwhile, China, the Chinese leaders, they want to stabilize their economy because they got the Communist Party 70th anniversary next year. So neither side really wants it. So the markets are placing a bet that they're going to, calmer heads are going to prevail over time. Over the next 90 days, though, the markets are very spooky. So we're going to see, I think, continued volatility in the markets up and down. Some of it's just not going to make any sense at all. You'll be up for the day and then you'll go out and have lunch and you'll come back and you'll be down 100 points and be like, what happened, right? And that's just kind of where we are right now until some of the tensions are smoothed over. My big worry is because the market is leaning one way on everything, meaning these things will be resolved. And then let's say they're not. And let's say that Trump throws another 25% tariffs on the remaining 325 billion or so in goods from China. That's going to upset the markets. The markets aren't prepared for that at all. And that'll result in a good pullback, anywhere from 10 to 15% from where we are right now. Okay. And that can make it fairly ugly. I believe it would not be that pretty. So we're only down 2.5%, something like that right now. A 10% pullback from the all-time highs takes us down to about 2665, and a 15%, a little over 15% takes us right down to that magical number 2500. So I don't see us taking out the December 26 lows that we made in December of this past quarter, but I do see us challenging the 2018 open and being just almost flat because the markets are always going to overreact, and I think you'll see buyers step in. But that's just something that concerns me right now when everybody's on one side of the boat. Okay, I mean, in reality, if you apply logic to it, the U.S. has a 21 trillion economy. And even if we put a 25% hit on all the goods coming in from China, which is around 500 billion or so, it's relatively trivial to our 21 trillion economy. I mean, it's just huge. It's small. It's really not a rounding error, but it'll reduce our GDP a little bit, but not by much. Okay. Now, China is going to affect them a lot more because their economy is not nearly the size of ours. But again, that's not how markets work. As you guys know, markets are not rational and logical. They're emotional, and they're going to overreact both up and down like we did in December. So we can expect an overreaction to the downside. And we can expect volatility to go back up into the 30s, even the 40s, maybe even spike on a high 40s, maybe 50, just to get a spike, right? So just understand that. For our members this Sunday evening, we're going to be going through some hedging techniques that we can use that really work out well in markets like this, that you don't, it's just kind of a set and forget over the next 30 days. So we're going to be looking at those and putting them in place because there's just too much. Everybody's on one side of the boat, and when that happens, I just get a little bit nervous, as I said. Okay, so having said all that, why don't we come in and let's take a look at the markets. What I've got on the screen here is the S&P 500 E-mini futures, and I've got it on a weekly chart. And you can see on this weekly chart here where, depending on how you want to present everything, you've got a top, a little bit of a higher high and a little bit of a higher high. So we are making higher highs, but we got a low and a lower low here. So it's typically when you go through a topping action in a bullish market, it takes time. I've seen it take as short as 6 months. Um, and I've seen it take 2 or 3 years. The fact that this was a higher high right here is a good sign from right there and then from right there. So that was a good sign. And this flush out right here that gave us that V move was primarily about Powell. That was all about our buddy Jerome, Power Ranger Boom Boom Powell, as I've said again and again. So if we discount that, you'll see that yellow line coming across left to right on the screen. That is where the most volume has taken place at price, right around 2675, just slightly south of the 2700 over the past 90 weeks. All right, so that's a very firm, hard support area. And that would be, well north still of the 2018 close. So we would be still in the green, but that would take us down to about 2675, something like that, which is around a 10% move lower from these highs right here. Okay. So if we get that, we'll probably get one of those kind of shifts down here like that. You'll see buyers start to come in. But that's what we want to be prepared for. And then we hope that it doesn't happen. But that's kind of what we want to look at. That's what I want to prepare for. And we just want to have have it set up like that. Okay. So this is on a weekly chart on what I'm looking at here. And then you can also see I've got some shaded zones in here that also represent support areas. And what I'm going to do is I'm just going to take it back into a daily chart here real quick. Let me just do that. Get these things off the screen here. And let's just come back into a daily. And then you're going to see these support areas show up a little bit better. Now I've got a new value area, this yellow line on the daily, because now I'm only going back, instead of 90 weeks, I'm going back 90 days. And you can see the value area here is sitting right at around 2791, right? And just slightly south of where we came down to on the 14th of May when we had that bottom, and then we've had this little move up here. So a lot of people are saying, is this a buy the dip moment? Should we move a little bit higher? If you look at the Elliott wave count, it would suggest we're going to go higher. But keep in mind, all it's going to take is a Trump tweet and then a Xi rebuff from China, and we're going to come out and take out these lows here. All else, assuming that was not present and the markets were all else being equal, then I would buy the March higher. But we've got to be very careful here, all right? And this is why we're hedging our bets as we move forward. Okay, so this is the E-mini S&P 500 futures. Now, if I shift this screen over and show this to you as an Ichimoku, okay, and then just kind of look at it, it's going to say, the same thing roughly. But if we look at the Ichimoku here, looking at the E-mini S&P 500 futures, you will see the green cloud here is acting as a support zone for us. And you can see these yellow dashed lines based on the Ichimoku is where we would expect to find support. Like it, you'll see one here at 2788, 2746, 2688, just where we would expect to find support. You could see we got a sell signal on May 13th, okay, in this Ichimoku. And we're still in a sell condition on this daily chart. And this shows that we could come down in this area here, still maintain our bullish stance, yet have a little bit more weakness. So these are just some of the things that we're looking at here. And for our members, we'll go in a little bit more detail on some opportunities around all of this. But for now, I just want to remind everybody that we need to be very careful and very sensitive to market action, because this can get ugly really quick. And I think this meeting coming up with Xi and Trump in third week in June roughly is going to be really key. Now, leading up to it, Trump does a lot of happy talk, and that's just kind of how he is. But I want to see how the Chinese respond and see if we can get some positive momentum out of this thing. Otherwise, it's going to get a lot uglier, guys. More so than what we're seeing right now. The markets, like I said, have not priced in a no deal. They've priced in a deal. The issue is the timing of that deal. I think the markets had originally thought it would happen over the past week or two. It didn't. They've probably moved it out over 90 days or so. I think it's going to go all the way into 2020, which is going to cause some more agita for the markets. Now, the one that's really got me concerned, though, let's look at the Russell. And why don't we look at the Russell futures first? Let me find it on here. Here we go, right here. So if we look at the Russell futures, we were in this down log or down move in this regression channel. We broke out. We almost came to my point here. I was forecasting it would come up to about 1634, came up to 1621. That was a pretty good forecast there, and I did that forecast back around the late part of March. All right, we broke out of here and we came right up there. And you can see here on the daily chart, the 50 has moved back below the 200 on the EMA. I don't think it's done that on the SMA, but on the exponential moving averages, the 50's now gone back below again, and we're below both. We're below both the 50 and the 200 here. Remember, the Russell is where a lot of risk goes when the market's feeling like it wants to take risk. And right now it's saying, I don't want to do that. If we were to put this on a weekly chart and just step it out a bit, you can see here that on this weekly chart, I've got a wider pivot range. The pivot low here is around 1440. The pivot high here is around 1562. So we've got about 220 from 1560 down, or no, 120 rather, roughly about 120 points wide range here for the Russell. If the Russell gives it up, then we're going to see others give it up too. The other thing is, notice the Russell is so much weaker. We did not climb up and take out our all-time highs that we made in September, early September for the Russell last year. Just did not do it, right? We made a new pivot high here from here, which gave us a 2019 high. But we haven't done this yet. So this could be a long drawn out way of saying the markets are may chop around a little bit, but we're in the process of a topping action over the next year or so. And that lines up with a lot of forecasts of where these things can go, at least with some people believing that. Okay. Let me just go back to the E-minis for just 1 second, the S&P 500. You can see on the S&P 500, let me get that off the screen here. I don't like that on there. Let's put it back on. So you can see in the E-mini S&P 500, we've actually been making higher highs. Okay. With the Russell, we haven't. The last high we saw in the Russell was in early September, September 2nd. With the E-minis, we made a high about the third week in September. So a little bit later, it trailed everybody else. The Russell led up, it made highs before everybody else, and then it's making lower lows right now. So if we look at the NASDAQ, and let's keep it on the weekly chart for a minute, you can see NASDAQ also made new all-time highs and 2019 highs. So we've made higher highs in both NASDAQ and the E-minis, S&P 500, but we have not in the Russell, okay? And then if we look at the Dow futures right here, you can see in the Dow futures, we did not make a 2018 high. So the Dow and the Russell are a lot weaker than NASDAQ and the E-mini S&P 500. So the Russell tends to lead the way up and down. So in the end of a bull market, when we start to roll over, and again, it's not a point in time, but it's a process, and it can take anywhere from 6 months to a couple of years. I've seen that work out that way. We could be starting that process already, and it may not be until 2020 that we give everything up, okay? Which is why the analysts have forecasted growth to accelerate the end of 2019 into 2020. And then a lot of analysts place the possibility of a recession higher on their scale of probabilities in 2020, right? And by the way, the Feds have got a forecast. If you look at the 30-day Fed Fund futures on the CME tool, there is almost a 70% chance of a Fed rate cut before the end of this year. Okay? I tend to follow the credit market and the bond markets, as you guys know. whether you trade it or not, but you want to follow it because the bond market, the credit markets drive the equity markets, not the other way around, because money is the engine that makes capitalism go. So if money's tight, you're going to see capitalism and stock prices pull back. And if money is loose and free, then you get the expansion of PE multiples and markets expand. So this is kind of where we're sitting right now on all the major indexes. If we look at the VIX, let me come down here to volatility. And if we look at volatility right now, you can see we're in the yellow zone. Let me put it back on the daily chart here. So I zone out my chart, and you can see as long as we're in the yellow zone, then I believe we've got a major risk to the upside. You can see, as I said, 23 was kind of the high that we made when we made that low on 5/9 earlier this month after that crazy tweet on Sunday, and the markets really cratered. Um, and it was just a complete about face in the markets. There was happy talk from China, happy talk from the Trump administration going into the weekend, and then everything reversed completely, a 180 shift the next week, which is really not good. The markets weren't prepped for it. And as you know, markets hate surprises, and that's what happened. So if we get another surprise in the market where the market still, as I said at the beginning of this uh, session here, as I said, the markets are expecting this thing the tensions to ratchet down and then to get a deal done in the next 6 months or so. Um, and if we don't get a deal, market's going to continue to move lower, okay, to the tune of, I think another 10% from here down. If we look at the front month vol futures or the term structure, you can see we're slightly in the red, which means the VIX is higher than the volatility, front month volatility. So that shows we're in a backwardation condition. Remember, the VIX and the vol futures have to equal each other. And since the vol futures are expiring next week, then both the VIX and the front month vol futures will be equal. So it'll be right on that yellow line, right at about 0. But if we look at the back month, okay, you can see the back month, all of a sudden vol came back out, or the term structure came back into a normal market. The markets truly right now are a lot more relaxed. You can see when you're in the green, you're in a contango term structure in the vol futures market. That's a good thing, all right? At least it shows that the markets are a little bit more relaxed going out into the June time frame, because there's the G20 and Trump and Xi are going to get together, so the markets are kind of have high hopes for that. But you want to hedge in case things don't work out that way. And then, of course, if we look at the tracking stock for China, you can see just how ugly China's been. All right, this is worse than all of our indexes. It's just tracking all the way down here. We're coming down near the. You can see the 2019 low was actually made on the 3rd of January. I mean, we're still in the green for the year for Asher, which is the tracking stock for China. We're still in the green, but we're going to be in the red if these tariffs continue and a stalemate comes up. We're going to make new 2019 lows, and we're going to see the U.S. indexes all move substantially lower from here. Okay, so just understand that. If we look at treasuries, one other thing I wanted to show you. The global market index, this is the all world index, it's also faring a lot worse. The U.S. is the only game in town right now. It's the only game in town. And from emerging markets to Asian markets, Chinese markets are all down. All right. If we look at emerging markets, you're going to see pretty much the same thing on EEM, which is kind of a proxy. I mean, we're just barely off the 28 of where we started in 2019. I mean, we've given it all up. So, and this is going to have the effect of dragging everybody down with it, including the U.S., if it does escalate further. Hence, this is why we got to put our hedges on and just make sure they're pretty strong. If we look at the bond market, you can see the bond market is doing what the bond market does. It's going higher. Interest rates are going lower. Okay. My forecasted spot for interest rates was 2.5. And if we look at it now, it's sitting at 2.39. This colored bar right here was where I thought interest rates were going to go. And I had it there almost the entire year. And we blew right through it. We blew both to the downside and the upside. And now look at us. We're way down here. This is going to act as resistance. It's about 2.5% interest on the 10-year Treasury note. Okay. So that's kind of where my, for me, we don't want to go much lower because it's going to have a tendency to flatten the yield curve, move us inverted, And remember, an inverted yield curve is not a big deal short term, but it does tend to forecast a recession anywhere from about 8 or 9 months out to a year and a half out in time. And we're near the lows here in interest rates for this year. So we got to watch this with caution. The US dollar is getting a lot stronger because the other countries are getting a lot weaker. We've been in this upsloping regression channel here going all the way back to the late summer of 2018. And as I've been working with our members on, every time we get towards the northern boundary, you don't want to be long the dollar, you could be long the euro. But every time we get down to the southern boundary, you want to look at entering long the dollar or short the euro. And that's just kind of where we're sitting. Because if we look at the euro, it's just the opposite picture of the dollar. Remember, the euro accounts for about 50, almost 58% of the value of the dollar, because it's really not the dollar, it's the dollar index. And here's the channel as we come down. It's a fairly wide channel like the dollar, which means it's very choppy. But we're just making a series of lower highs, lower lows as we work our way down. And as you can see here, we're coming down to the lows of 2019. All right. And right now the euro is down to about $1.11, 1.118, and I think it can go lower. All right. So that's what we're seeing in the currencies at this time. And then the yen, which is a flight to safety when global markets are in turmoil, and this tends to follow the bond market. You can see it's been moving up really since the third week in April, all the way through to about a week ago to the 13th. And this week it's pulled back just a little bit, I think, in a profit taking mode. But there are no divergences here. So if the markets get worse, then we're going to expect the yen to continue to go up. This was what the yen did in the month of December, just showing you. So just remember, the yen is a flight to quality, or not quality, safety. So when the market, it tends to follow the bond market. All right. So that's a little bit about the currencies. If we look at oil and look at this commodity structure here, remember what I said about this regression channel. Oil has been running up, and now we're outside the regression channel. We're in more of a sideways market right now. We're right over a value area. The value area over a 90 days back is 62.37. We're almost sitting right on it right now. All right. I think, and the 50 has just crossed the 200 this past Friday. EMAs now, not SMAs. So that would indicate that it's going to serve as a firm support area around the 61.30 area for us. Like I said earlier in this session, I think oil naturally should be in the mid to upper 50s, not lower 60s. It's being artificially held there by a combination of production cuts by OPEC, geopolitical issues with Iran, Libya, Venezuela. Quite frankly, I'm surprised oil's not even higher, but that's kind of where we're sitting right now. Remember, if the global markets tank, oil is going to come down with it. So that's the only thing keeping a little bit of a pressure lid on oil right now, okay, the demand side. And then, of course, if we look at gold, gold has really not acted in a very strong way given the nature of the turmoil with China. You can see I've got this green upsloping trend line right here. You can see it's kind of a head and shoulders pattern, right, to the downside. I had projected down around the 1230 to 1220 area. I am not long gold. If anything, I would be more neutral to short gold. I said, unless we break out of this regression channel and move up and probably clear up above here around the 1305 area, then I'd start to take more interest. We're not there yet. Now, if we do get some global turmoil, you may see gold break out of this and make a run up higher, okay? But outside of that, no, I think that's just not something I'm going to want to play. In fact, I think a lot of people probably ran into Bitcoin because we've seen a huge run in Bitcoin recently, okay? And then the other one that some of our members took and shorted based on our recommendations here made a killing. Remember, right in this area here, we got a trigger to short palladium. There are no options in this futures market. So I told everybody that the move is going to be exaggerated because you can't use a call or a put to hedge or counter trade in the futures market. So what happened was we fell, and some of our members made $20,000 to $30,000 per contract on this trade in less than 3 days. It was a great trade. Okay, but we've been stalking it out for quite some time, and we just waited and had patience, and we got this the trade that we wanted, and it was taken. So that's a little bit about that. Um, Soybeans is really just getting hurt, all with this China trade deal. There's still a lot of downward pressure. Let me put it on the weekly chart here just to kind of show you the scale. You can see here on this weekly chart, we've already made new lows. And I've got what I'll do is I'll update the chart for next time so that I include the 2019 prices. But if I were to go back in time and just show you on this weekly chart here, just to kind of show you how far out we go. Right now, we're down around this area here, which the last time we've seen this was in 2008, Q4 2008. So that, folks, that's a long time. And if let me just see if I got it. I think I got a monthly chart on here just to really step it out. So if we go back to a monthly chart, and this goes all the way back to 1975, all right? So that's a long, long time. And I were to move this out here, you can see we're coming up on some very serious, and this is monthly support here, big time support areas down here. If we get down in this area, then I'm going to be interested. I don't know if we'll get this low, but getting down in this area, I'm getting more and more interested in selling out of the money puts, doing bull put spreads, or doing deeper in the money bull call spreads on this thing. I think we're forming a low here. If I were to just plot a potential location for the Elliott Wave 5, we're sitting on it right now. All right. So this means here, you can see, let me just, and again, monthly charts have more influence than weekly charts, which have more influence than daily and so forth. So the market's fractal. So you can see this move here came right down and touched this area here, and then it bounced off of it. So this area we could consider hard support, $7.73 and 3/4 of a penny, 773 spot six here, right? So that is the soybean trade, and I think there's going to be some good opportunities here. But we got to get through this Chinese hurdle here before things start to square up on it. Okay. All right, everybody, that's kind of where we're sitting in the markets right now. I just wanted to give everybody an update. I hope you have a great weekend. Members, I will see you this Sunday evening for our weekly market watch. If you're not a member, I strongly encourage you to come in. We're having a good year, regardless of what everything else is going on around us. And I'd like to see you guys on the inside. Members, see you Sunday night. Everybody else, I'll see you the following weekend. Ciao, folks.